Welcome, everyone. This is Jean Newell with your Hometown Solutions, where we talk everything real estate from foreclosures to Feng Shui. We're kind of the HGTV type of show, but on radio, and we talk about remodeling, we talk about mortgages, foreclosures, hardest hit program, all kinds of things. But today we have a surprise guest. But first I would like to introduce my co-host, the esteemed Jonathan Lack with Lack & Lack Chartered, as well as Waterview Realty and Waterview Title Company. Welcome again, Jonathan, to our show.
Thank you for having me back, Jean.
Well, you are always a wealth of information, and we talk about all kinds of things with law. And what's really interesting, because you wear those three hats as a real estate attorney, as well as a title company and a broker with a Waterview Realty, is there's all kinds of different scenarios that come through your office as far as people looking to buy, looking to sell, and we see all kinds of things, foreclosures, you're involved with short sales, but we also get the question about taxes and various things like that we go right to the source. So tell us a little bit about who our special guest in the studio is today.
I am very excited to introduce Dana Blickley, who is the Brevard County Property Appraiser. So welcome to the show, Dana.
Thank you.
And we're going to talk today about Dana's job as the property appraiser is to assess the value of your property. She does not assess the taxes. She's the one who determines the value of the property, and then the tax collector is the one who goes ahead and collects your taxes. Is that right?
She gets all the money.
Okay, there you go. But I get the question all the time about how the property appraiser comes to the value. One thing I'm going to bring out from my past, and this is going back about 25 or 30 years now, it used to be very stable property values. And as an attorney back then, I'm still an attorney now and also the real estate broker, but it used to be that we would say, all right, the property appraised value is typically about 70% of the market value. But of course, when the market went kaflooey in 03, 04, 05, and then worse still in 7, 8, 9, the rules of thumb all went out the window, and you now have to assess the property values based on the current market condition. I guess you always did, but now it's just a little harder to do, I'm guessing. So can you tell us a little bit about how you go about assessing the property values?
Sure. Well, the method of actually determining property values hasn't changed in all that time. What has changed is the property tax equation. I'm sure we'll get into that a little bit on the show. So in terms of determining market value, probably the biggest fallacy that anybody thinks is that the property appraiser determines value, and nothing could be farther from the truth. The value is actually determined by market transactions that take place from you good folks, and we glean that information from the clerk of the circuit court through recorded documentation. So I don't get to say what a house is worth. Your buyers and sellers get to tell us that through their transactions. So that's the first 101 course in property appraisal. What has changed is the property tax equation. So, for instance, back in those years that you were speaking of, if someone applied for a homestead exemption, they received a $25,000 homestead exemption. And that was pretty much well across the board. There are other personal type exemptions, but all of that worked the same way, and it applied to all taxing districts. That is not the case anymore. So now we have market values, which are basically synonymous with just value or market prices. You have assessed values, which are factored values based on the year in which a homestead exemption is applied for and received. And the net result is the taxable value, which is the actual value applied to tax rates to determine how much money folks pay.
All right. One thing, just to give everybody the information that I received earlier, is the website at bcpao.us, which stands for Brevard County Property Appraiser's Office. So bcpao.us has a plethora of information, including all of the stuff that you just explained, how the properties are appraised and how the taxes are applied. It was a wonderful website, and I highly recommend everybody visit that. In addition to the research you can do, which I do as both an attorney and a broker, I'm often looking at the property appraiser site for the exact information that you just discussed about the property values. One of the things that I was enlightened to is typically as a realtor, when you think of an appraised value, you have an appraiser go out to the property and look at it. in your case, you're doing what are called mass appraisals, where you're appraising the entire either county or subdivision or area, which is very different than what I learned from the website as a fee appraisal. Can you explain that a little bit?
Sure. So you're correct. When a fee appraiser comes out and looks at your property to give an appraisal for a personal reason, typically that individual is going to, glean all the information about that particular subject property and find comparable properties and make adjustments to determine a value. We do the same thing, but we do it in a mass appraisal basis, churning information using a multitude of CAMA products, and that word is computer assessed mass appraisal products. So we're putting in thousands and thousands of bytes of data, and we're using mass appraisal techniques to pull that information into certain modules that give us models and values for particular properties. So for instance, it's not that we don't have specific information on every property. We do have that, and you find that on our website. So you can look at your particular property and see how big your base area is, whether or not you have a pool, what value is established for that property. We're doing that, but when we are measuring transactions and changes in the marketplace, we are always doing that and those changes on a mass basis. So we're taking in all of the sales information, we're extrapolating out of that what is a good sale and a bad sale, and we'll talk a little bit more about that. We glean from that prices that are representative of market areas, and we apply that to a mass number of properties to determine any change in value if it's needed. So it's the same three approaches to value, but just on a mass appraisal basis.
All right. So when you have what you called a good sale or a bad sale, if somebody's overpaying for a house because for whatever reason they really want it, or because of some distress situation, they're what we would call underpaying for a house, that outlier is not going to necessarily directly affect the assessed value of that particular property.
That's correct. What we are going to try to do is take that sale price and make sure that we are designating what part of that sale price represents the actual bricks, mortar, and the land. So what we do is we send out something called a sales questionnaire in lieu of an affidavit that used to be required by law that gave us a lot of this information. And typically we're looking for things like this. Did you sell this property to an affiliated party? Did you sell this property to your brother? Was there atypical financing that affected the sale price of this property? Or was something included in the sale price that doesn't represent the actual piece of real estate? Once we glean that information, we may find our answer to why a particular property sold for 35% more than all of the like properties around it. So that's how we determine when we talk about good and bad transactions. Not necessarily that they're bad transactions, but they're not transactions by law that we can use to establish market rates.
So in advising my clients, is it true to say that a few $1,000 swing is not really going to affect the assessed value of their property? Again, I don't want to put you on the spot. If that's not a true statement, please.
That's a blanket statement that is in the aggregate correct. No. So, for instance, the way I would explain that is you as a potential buyer might be willing to pay 7 to 10% more for a piece of property to be in a certain school district where my children might be grown, and that might not be something that is a motivator for me as a buyer. So those are the type of things that really kind of flush out in the range of value for properties. And as you know, in this business, there's always a range of value for a property. There's, the price someone pays is only good for the day they pay that price because we're all motivated by different things. So to answer your question, yes, those are watered down, and you will, if the range of values that are applied or the market prices that are applied that are fitting for like properties.
Okay.
I have a question that you brought up, something that triggered this. If someone's remodeling their home, and let's just say they're going to put $50,000 into remodeling, if a lot of it is laying tile and redoing the kitchen cabinets and so forth, it wouldn't necessarily affect their appraised value. But if they add a screen porch and add a fireplace and things and a bathroom, which makes the square footage bigger, that would make a difference on their next year's tax assessment. But how does the tax office find that out?
Okay, great question. So the way that process works is whenever you're doing that type of project, you typically are required to take out a permit with whatever jurisdiction the property lies in. So If you were to be in an unincorporated area, you would be filing for your building permit with the county or whatever municipality. When you do that, we get a copy of that permit. Now, generally, there is a pretty good description and a type of permit, and it will tell us pretty much, well, the activity that's going to go on that property. Some of them, if you're just retiling or you're re-roofing or things like that, those aren't things that generally extend or change the economic life of the building. So you're right. Those things probably would not initiate any change in value. But if you change the building footprint, you're going to add 500 square feet of living area. You're going to put in a pool or add out a really nice outdoor kitchen. Those are things that likely the market would recognize and we would recognize as needed to be picked up, added to the market value and assessed value for the property, and subsequently taxed through the extension.
Now, I have clients who occasionally the property appraiser site might be not reflect. It might say it's a 3-bedroom, 2-bath, when in fact it's a 4-bedroom, 2-bath, or maybe vice versa, but that's more commonly the case. Is that something that the client should address? And if so, how?
Yes, except for the fact that you won't find bedroom and bath information on our website. And the reason that you won't find that is because that is not a variable that we use to establish value. What you would see is the total square footage for the base area of the property, or the square footage applicable to a screen porch or some other type of improvement. So if you were to notice that information you felt was incorrect, then yes, absolutely. We certainly don't want to be over-assessing or understating your property. But you won't find bedroom and bath information because typically in homes. Mm-hmm. So we do get copies of plans, but generally what we're using is the base area and establishing base
so
rates
it is the square footage that we should be looking at. And if it's wrong, it should be corrected. So what I must have seen was probably culled from another source. Again, I wasn't looking at the property appraiser site maybe, but some other realtor tool that I'm confusing.
Sure.
And it is important then I can advise my clients that bedrooms and baths are not relevant to the property appraiser. Now, of course, it is relevant to your individual fee appraisal from your appraiser and for the sale of the property, but not for our overall tax base.
Correct.
Do you actually physically go out and look at properties on every 10 years or every 5 years just to bring things up to date?
There is a legal statutory requirement that all properties are to be inspected once every 5 years. So that means that all of us, all 67 of us, must get statistically to 20% of our properties per year. What has changed in the past few years is the fact that desktop inspections, aerial photography, are substitutions for physical inspections if the pictorial view is enough where you can see the changes. So all of us now utilize pictometry type products for these inspections to meet these inspections. But whenever you have, say, a great amount of canopy or you have obstructed views, then yes, we have to physically go out and inspect the property.
Mm-hmm.
Right, and all of that information, is for the record, is at the website, because I read through this, and again, it's fantastic information available to everybody at bcpao.us.
Tell us who we've been talking with.
Okay, I'm sorry. We've been speaking with Dana Blickley, the Brevard County property appraiser, and she's advising us on how the property appraiser assesses the value of our property so that we can pay our taxes.
One of the questions that we see all the time is, especially in condos, it also happens in subdivisions where there's only 1 or 2 floor plans, but basically everyone's home is virtually the same square footage. But especially in condos where there might be only 1 floor plan for the entire condominium, and let's just say there's 30 condominiums in that building, and maybe it's 25 years old. So we get this question all the time is they'll see taxes on the listing, and those people are paying quite a bit less on taxes because they've owned that property for 25 years. And when they buy it, we know they're going to be paying higher taxes because it's set a little differently when you purchase a new one. But explain the reasons why people side by side in a condominium can be paying a wide variety of taxes.
Well, the only reason, if you had an identical unit, particularly on the same floor, and you had a difference in property taxes that was being paid for, it is absolutely attributed to either an exemption or the exemption plus an assessment cap. So For instance, if you have owned your unit for 25 years and you applied for a homestead exemption 25 years ago, you've had that protection year after year of your assessed value not exceeding 3% or the CPI, whichever's less. As you know,